Oh my gosh, that is a revelation. Holy crap. They're completely clueless. Completely and absolutely stupidly clueless. That's what the Federal Reserve is. And I hate to say it, but you probably agree. I'm just going to throw up a few samples here, and then let's have a conversation about this and think about this, okay? So why don't we go into right over here, and let's take a look at this. While my model scenario contains a near-term slowdown rather than a contraction, it is actually pretty rosy to compared with what I fear might happen. Okay, so things are rosy. Okay, this is one example. I'll tell you what these are from in just a moment. Here's another one. My contacts, and this is all from the Fed, mind you, my contacts tell me that because the economy continues to be reasonably healthy and people have jobs, things are still under control. But if house prices and the stock market, interesting note, fall further and the economy appears to be weakening, then there'll be further lending tightening, and that tightening of lending conditions could end up creating a self-fulfilling fear of a crash. This is basically a way of saying, look, when people are able to borrow, you can kind of sustain spending and GDP and the economy, but as soon as people are unable to borrow because maybe housing prices weaken, the stock market weakens, and then banks start reining in going, ooh, we need to be careful, then you can self-fulfill a crash. Okay, interesting comment. And then we have this comment right here. Credit quality is actually a better story. Except for residential real estate, it's still pretty good out there, basically. Talk a little bit about this being good, that being good. Other than some pain in residential real estate, quote, everything is good. The other consumer credit feels like a mild recession, but again, it's cyclical. Now, what could I possibly be reading from? What could possibly be so rosy? Or what could possibly be so exciting to the Federal Reserve that they're seeing cracks, but maybe there's something brewing? Well, folks, these are none other than a reminder on the expiring coupon code on the courses on building your wealth tomorrow at 11:59 p.m. Email us at staff@meetkevin.com if you have any bundle up requests. Did have a bad last 2 days of trading, but today we got some beautiful, profitable tendies. I made a little mistake at the end of the day yesterday, and one trade ruined my last 2 days. So that can happen, but today we're profitable on today's trades, and we're hoping to be profitable as far as we can go forward. But I just like to be transparent that I send a lot of ideas, a lot of great ideas. People love them. We've got hundreds of people, sometimes upwards of 1,000 people in our course member live stream. I mean, this morning we spent like an hour and 20 minutes just talking about trades and ideas and when to go in, when to go out, and how to move things. So it's really fun. If you're not part of it yet, make sure you join, linked down below. Okay, so what is this actually, folks? These documents are from the Federal Reserve. They're transcripts from the Federal Reserve FOMC meetings. Take a look at this. This was December 2007. December of 2007. The economy continues to be reasonably healthy. Okay? January of 2008. I just went through all these this morning. I was reading them. They're so fascinating to read. This morning, what do we have here? It's just a slowdown, guys. It's not a crash. It's just a near-term slowdown. Things will be actually pretty rosy. That's January of 2008. And we got to talk implications in just a moment. But look at this. September of 2008. This is like Lehman Brothers time. Lehman Brothers time. Other than that, everything is okay. That's the Fed. After Lehman Brothers collapses, everything is okay. No, it's not. Obviously, the Fed famously bailed everything out in February of 2009, well after Congress tried bailing things out in September, October of 2008. But we need to talk implications about this because this is a pretty big deal. A lot of you are, quite frankly, sophisticated investors, and We just have to be real about what's going on in markets right now. Markets are obviously topping. We're starting to get signs that potentially we're seeing more layoffs again, and this is a problem. I like using layoffstracker.com. Take a look at this right here. You can actually sort by tech or non-tech, and we're only about halfway through April, but if we continue this trend, April is going to be as high as May of last year. And that's weird because it's an indicator that companies are starting to realize, crap, we might not only be higher for longer. We just heard Bostic and Williams this morning say, look, we don't need to rush to cut rates. In fact, we'll cut maybe at the end of the year, maybe. Markets are only pricing in 1.5 rate cuts by the end of the year. But these layoffs, they're not just a Tesla problem. I think they're going to be an economic problem. This is tech, by the way. I want to tag over here. We can jump on over to the non-tech. And let's get rid of all this spam that they try to pop up. Quick note also, if you are interested in Househack, we're doing an in-person roadshow. So if you want to meet me in person, do me a favor, click the link down below. You're going to see metkevin.com/roadshow. And it puts you through, I want you basically to vote on what city you want me to go to. So between next Monday and probably about May 2nd, we're going to do a road show. So we'll meet you in person, shake your hand, talk to you about Househack, mini funds, explain what investing in Househack is all about. So if you're interested in that, we're probably going to do it at where we land. So they're called fixed base operators, the FBOs. They have little meeting rooms and stuff there, so we'll be able to do a meetup with myself and the team, and you'll be able to meet the team, so it'll be pretty cool. So check that out if you want to. Again, click the link down below so you can vote on which cities you want that to be in. Anyway, back to layoffs. The layoff tracker doesn't work for non-tech, so I went over here to warn notices, and we're seeing this uptrend on warn notices. I want to be really cautious about this. And so a lot of people have been asking me, Kevin, why are you so bearish? Not only do I think that we're going to have a really hard time comparing to 2023 earnings. Think about that for a moment, okay? You have to compare to 2023 earnings. So if Q1 misses at ASML and TSM, or rather they beat, but their forecast isn't as great, and the stock drops, remember what happened to ASML. Let's just look at it. These are we're just starting earnings season. What happens at ASML here? Let's go to the average candlesticks. Boom, right back to our retracement line, okay? If you trust the lines, trading is a lot easier, I found. And that's why we like sending alerts with the lines, okay? That's not a good situation for TSM. Down 5%, that doesn't look very good right now. You get a Netflix, you could technically have a beat and a bad forecast tanks. That could happen across all of AI. I think that's exactly why we're starting to see NVIDIA start selling down. So I'm very nervous about Netflix today because I think even if we beat, if we have a bad forecast, we go down. But remember, we have to compare to Q1 23, Q2 23, that's full AI right there. Q3, Q4 2023, both of those full AI. So it's going to be easy to miss this year. I think a lot of companies are unfortunately going to realize that in order for them to actually increase EPS, they're going to have to lay off more. And they're going to have to go through painful layoffs. The expansion of credit won't drive this economy any further. I think we're out of money. This is why I've tweeted, I'm sincerely fearful the entire stock market is about to take a giant poop emoji. I've been raising cash and I've been complaining since March, but I think the real pain is about to hit. I pray that I'm wrong. And people say, like, oh, Kevin, well, if you're in cash, why would you pray that you're wrong? Because recessions are nasty. People get laid off. They lose their jobs. Their startups fail. They go bankrupt. They lose their homes, their car, their relationships. They get divorced. People die. I'm not trying to be, hyperbolic here. It's just recessions suck. And the reality is the 10-2 has never been wrong about a recession coming. Now, I've not been a recession bear. I've not been the person saying, oh, I think a recession's coming. I haven't seen that at all. But I think partially that may be because we got really propped up by AI. But what happens when we start having to compare to those growth expectations for AI and those expectations start coming in softer, just like what we saw? Remember, ASML, they had expectations of a 4.3 billion euro quarter. And their forecast was 3.3. That's like a, over 20% miss. That's really bad. And so what that does, if the AI anchor or sort of foundation to this market tanks, I don't want to know what that does to everything else. Now, a lot of people say, oh, well, maybe people will go from the AI stocks and buy other stocks that are beaten down, like Tesla. I want to have that hope. Like, sincerely, I want to believe that that is going to be true, but I think if AI blows, this entire market goes to crap really fast. And I'm not actually really concerned about a correction. Like, who cares? The correction is something you would expect, right? Like, okay, cool. I don't know, a 20% pullback in the Qs. Okay, big deal. Like, you're still going to be up, right? But wait for it, okay? That's what I want to talk to you about. Just wait for it. So we're at 423 right now. Clearly, we topped out at about 449. So we go back to 406. That's easy, okay? That's an easy correction. I think it's much more likely you end up going down to like a 373 pretty quickly. Honestly, 373 is not that big of a deal. But let's say we go down to 373 divided by 420, 423. That puts me down about 12%. I'm not even at a full correction. How about if I go to 348? 348, that gets me to about 20%. It's like 18%, but that gets me down here. That's not unreasonable. That would be that sudden dip we had in October. Revisiting that October low, reasonable. But what happens if at the same time as all of a sudden you have this concern over, oh no, the stock market is going down? Watch this. Remember this from the beginning of the video? I hate saying this, but watch. I'm gonna read it again. If house prices and the stock market fall further and the economy appears to be weakening, then banks will further tighten the lending conditions and terms on consumer loans to avoid problems down the road, and these fears could be self-fulfilling. In other words, the resulting credit crunch, it's their words, the resulting credit crunch could push us into recession. Okay? So think about that for a moment. Right now, people still have the capacity to borrow on credit cards. Credit card spending is going up. But what's happening? Remember the bank video we did just a few days ago? This is scary. I don't want to be a bear because it's so bad for the entire economy. But we know borrowing has gone through the roof. Buy now, pay laters, credit card borrowing, all that borrowing is going through the roof. We know that at rates that are insane. It's stupid. But what did we start seeing at, I kid you not, Bank of America, Wells Fargo, Citi, JP Morgan? What did all of the banks say? Much larger charge-offs. Charge-offs 70 to 100% higher than what they had at the beginning of last year. And then they're trying to cover that up in their earnings per share by taking lower loss reserves. Well, what happens when you have lower loss reserves and then you have more charge-offs at the beginning of 2025? It's got to be a big oopsie-doopsie miss. Maybe that's why Jamie Dimon just dumped 1 million shares of JP Morgan between February and April. Then banks have to start increasing their risk aversion. How do you increase risk aversion? Increasing risk aversion would be taking less risk, right? You tighten credit standards. So you lower the number of people available to borrow. Okay, well, once people are capped out on their borrowing or their credit limits get capped, can't spend as much anymore. Oh no, now you got to repay your debts and you can't keep spending. That's how you go into a recession. They literally outlined it right here in December of 2007. Except, of course, the economy is reasonably healthy because people still have jobs and things are under control. We're not going to see unemployment claims go up until we're already in the recession. Okay? St. Louis Fred, unemployment claims. I want you to see this. I don't think people pay attention to this stuff. And again, my job is to really try to help, and this is my opinion, like I live for this stuff. It gives me excitement to share this. I believe my job exists to give people a perspective at something they're not seeing. That's why when I send trade alerts, sometimes people are like, Kevin, I don't follow the trades, I follow your ideas. Okay, that's perfect. You can do whatever you want, but that's why I always send these trade alerts. And it's same thing with House Hack. Even if you don't want to invest in House Hack, but you want to come meet us in person, and you want to learn what we're doing, great. We'll have a more in-depth thing, the Millionaire Symposium. That'll be, a 2.5-day event where we actually like explain and teach. But the house hack thing is the house hack roadshow. You can come to that for free. This is free. But anyway, look at initial claims. Again, I think people aren't paying attention to this, and that makes me nervous. I don't want to be nervous. You know how much hate I get for like being a bear? It is the most appeasing thing. Like, even other bears are like, you're not bearish enough. I'm like, God. But anyway, look at this, folks. Look at unemployment claims. When do they really skyrocket? In the middle of the recession, towards the end of the recession. Once the unemployment claims are skyrocketing, honestly, that's when you buy the dip. It's like, oh, when should you buy the dip in stocks? When unemployment claims are actually skyrocketing. When unemployment is peaking. When the pain is peaking. What a surprise. You buy the dip. And let's look at 2008. The stock market bottomed in March of 2009. Holy crap. I did not pre-plan that. Oh my God. Oh my gosh. Oh my gosh. That is a revelation. Holy crap. Now, I went into this video knowing that if I pull up unemployment claims, you would see that the unemployment claims go up during a recession. Honestly, I was not expecting the peak of unemployment claims to match when the stock market bottomed. Damn. I wish I wasn't a bear. I'm just really bearish right now. This is just the beginning. Look at this. Look at the Qs. Come on, man. Look at the Qs. Come on. We're about to lose the 100-day. Oh, man. I did make some money today. I'll reveal my trade to you. Today I had a few trades. I didn't make as much as I hoped on my Coinbase short, but I did make like $800 on my Coinbase short. I broke even on an ARM short, and on Tesla, I'll show you my Tesla trade. So Tesla, all of the screenshots of this are in the Stocks and Site group. On Tesla, I went short right about here-ish. As we confirmed we were coming down. And then we basically stayed under this 325 moving average. And I took some beautiful tendies. But that 252 line was really useful because we couldn't break it in the morning. And then when we got rejected again, that was enough for me to go short. I think I'm up like 11 or 12K or something like that today, which is nice. But it just makes up the whole of... I screwed up so badly on an ARM call because ARM was down 10%. And then I went for a call. I made money. Went for a call again, made money. Went for a call, then the market tanks into the close, and it dropped to like 12.3% really rapidly. That hurt. But that's trading, it happens, and I just want to be transparent. Again, my ideas are to help you trade, to learn how to trade, to share opinions and perspectives, and I send these alerts live. Not a lot of people actually do that, because it's hard to put your money where your mouth is, but I do it. So, anyway, thanks for watching. Check out that House Hack Roadshow link down below, and we'll see you in the next one. Good luck, everyone. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.